The Intelligent Investor Summary 5-part English version.
Part 1. Who is the intelligent investor? The intelligent investor isn't the one who makes quick profits, not the person who gets emotional when the market rises or crashes. Benjamin Graham says, investing is not about beating others, it's about controlling yourself. An intelligent investor thinks long-term, never speculates, never risks everything, focuses on value, not market hype. The real game is not to get rich fast, but to build wealth safely and steadily.
Part 2. The margin of safety. This is Graham's most famous principle. Margin of safety means you buy investments at prices much lower than their real value. Example, if a company is worth $100 a share, an intelligent investor aims to buy it at $70 to $80, not $100. Why? Because the world is uncertain. Companies fail. Markets crash. Unexpected disasters happen. A margin of safety protects you. It turns losses into small losses and profits into meaningful gains.
Part 3. Defensive versus enterprising investor. Graham divides investors into two types. 1. Defensive investor. Doesn't spend too much time researching. Chooses safe, reliable investments. Prefers index funds, bonds, blue-chip stocks. 2. Enterprising investor. Spends time studying financial reports. Looks for undervalued companies. Takes responsibility for research. Both are valid. You don't have to be aggressive to get rich. You just need discipline.
Part 4. Market Psychology. Mr. Market. Graham introduces a legendary idea, Mr. Market. Mr. Market is emotional. Sometimes he's optimistic and prices everything too high. Sometimes he's depressed and sells everything too cheap. Your job as an investor? Don't follow Mr. Market. Take advantage of him. When he panics, you buy cheap. When he gets overly excited, you avoid overpriced stocks. The market is a mood swing, not a guide. Part 5. The Intelligent Investor's Mindset. This book isn't only about money. It's about emotional intelligence. To be an intelligent investor, be patient, be disciplined. Understand your emotions. Avoid speculation. Think in decades, not days. Warren Buffett built his empire using this book's principles. The formula is simple. Value plus safety plus patience equals wealth.
Final word. Smart investing isn't about predicting the future, it's about being prepared for the future. Slow, steady, and rational decisions create long-term wealth. We've reached the end of another book summary video. If you have a book summary recommendation you'd like to see featured on our channel, please share it with us in the comments. See you in our next videos. Goodbye.